Hi everyone, I'm Rosemary Miller here with Kelly Phillips Erb, a senior writer here at Forbes, here to give us some end of the year tax tips. Thank you so much for joining me today, Kelly.
Thank you for having me.
Absolutely. So Kelly, how can individuals strategically utilize retirement and related accounts to defer income and contribute to their nest egg before the approaching year end?
So you have the opportunity to put money away all year long, but there are limits on how much you can give, and we actually have those outlined in our year-end tax article that's coming up. But also, you can find it anywhere on Forbes or IRS. It depends on the kind of account that you have, but typically you're looking at about 22,000 for a retirement account that's like a qualified plan, like you'd think of as a 401k, and about 6,000 for an IRA. And if at the end of the year you haven't hit those limits, the IRS says time, right? So if you're looking and you have a little bit of money, maybe you got a bonus, or you have a little bit of money you weren't counting on, you can actually put that money in one of these tax deferred accounts. And what that does is it also defers the tax, depending on the kind of account. I will say Roths are treated differently than traditional accounts, but for the most part, I think, with traditional accounts, is what a lot of people think of a traditional IRA. When you put the money in, it doesn't get taxed when you make the contribution. It gets taxed later when you take it out. And of course, the goal is that you're making more money now than you will when you're in retirement. So your tax bracket will be a little lower later. So you have the benefit of the deferral now, and then hopefully the benefit of a lower tax bracket later. And you can keep making contributions up at the end of the year, except when it comes to IRAs, you even have an extra wiggle room, which is that you can literally make it that kind. With respect to 401ks, your deadline is a hard deadline at the end of the year. But if you're a super procrastinator and you have an IRA, you have a little more wiggle room, because those contributions can be made all the way up to tax day, which is April 15, and it will still count for the prior year.
Well, Kelly, let's talk about charitable contributions. So in what ways can making charitable contributions, including rollovers and donations to donor-advised funds, serve as a means to reduce income while simultaneously contributing to a charitable cause?
So there's a lot of ways that you can give to charity, which is pretty awesome, that have some great tax benefits. The one way that most of us think about is just writing a check, or making a credit card donation. As long as you make those by year end, you are eligible, assuming that you itemize, you're eligible to deduct those on your taxes for 2023. And a lot of times people wonder, does the check have to clear? Do you have to have paid off the credit card? No, you just have to have made the gift by the year end, which is a good idea, especially if it's end of the year and you're kind of scrambling, right? There's other ways that you can give, and you mentioned donor advised gifts. And so what's really interesting about donor advised gifts or donor advised funds is that they are sponsored by a charity, but it is usually in a financial institution. So for example, Fidelity might have a donor advised fund. And so what a donor advised fund does is it allows you to make a contribution today, even if you're not really sure where you want the money to go. So let's say you want to spend $10,000, you want to make a $10,000 gift to charity, but you're not really sure where. You can put it in this fund, you get the immediate tax deduction now, and then later you can tell Fidelity, you know what, I really feel strongly about sending this money to Red Cross or the charity of your choice. You can't make them do it, but your suggestion, and it typically, as long as it's a qualified charity, they'll then make that contribution. And so you get the benefit of having made the donation to the fund early by year end, but you can take your time a little bit to figure out, where do I want this money to go? Like, how do I want to benefit charity? So that's a really good way. Donor advised funds, it's worth noting, do tend to be at a little bit of a higher price point, right? So you could write a check to charity for any amount, $5, but donor advised funds are going to have minimums. So they are, a little more strategic, high net worth planning, but still a really good option. Another thing that you can do is donate appreciated assets. I think sometimes people get a little freaked out when they hear like appreciated assets, because it sounds like it has to be like super wealthy, but not necessarily. I happened to buy Amazon back in the day before it became well, it was Amazon then, but now it's Amazon, right? So it's
Right.
appreciated. I've never sold it. It's sitting in my brokerage account. If I were to sell it, I would pay capital gains on it, and then I could write a check to charity for the difference, which would be a smaller check. But if I just transferred that money over to the charity directly, so if I donated the appreciated asset, I don't pay the capital gains, and I get the benefit of the entire value of the deduction. So it's a win for me, and it's a win for charity. So those are two ways that are really good. And then the third one that's worth mentioning is that if you're a little older, you can make what's called a QCD, which is a qualified charitable distribution. And that is a rollover directly from your retirement accounts. We mentioned those earlier. But when you get older, you're required to start taking that money out. And at age 73, it's called a required minimum distribution. And if you don't take a certain amount of money out, the IRS dings you. Much like with the appreciated assets, if you take the money out, it becomes taxable. If you then write a check to charity, you're giving them the after-tax value of that gift. But you can use this very specific rule to donate up to $100,000 directly from your retirement account to the charity. It's treated like a rollover if you've ever done a regular rollover. And the benefit is you get the full value of the deduction. It can count as your RMD, so you check those boxes, and the charity gets the full value of that gift. The best thing about QCDs that I don't think gets talked about enough is I mentioned earlier that you had to itemize to take charitable gifts to get the deduction. QCDs are never taken into income, so there's no offsetting deduction. It's like it sort of never happened from a tax perspective. You're literally moving money, it ticks all the boxes, but you don't get taxed on it and you don't get a deduction for it. It's just considered tax-free. That's a really terrific thing to have happen, but it also means that you don't have to meet any sort of itemization threshold, which sometimes can be difficult for folks in a post-2017 tax reform world. It's sometimes difficult for some taxpayers to kind of hit those thresholds.
Well, Kelly, could you discuss the benefits of harvesting losses and balancing out income, particularly in a scenario where there have been significant stock gains throughout the year?
Right. So it's funny, when you talk about harvesting losses, it sounds really dramatic. But basically what it is it's just a way of balancing out your portfolio. So let's say you had a lot of winners over the year. And so you're looking at, maybe you've actually sold some winners, things were going well for you, and you went ahead and realized those capital gains. Those are going to be taxable. Those are going to be taxable. But if you have losers in your take advantage too, if you sell them and you have losses, those realized losses can offset the realized gains. The important part is that you actually have to make the sales, because what's inside your account, sort of like what I was talking about with Amazon before, if something is appreciated, that in itself isn't a taxable event. It's not taxable typically until you sell it or give it away. In this instance, if you've sold throughout the year and you've racked up some realized, it's good to offset it with some losses. And the flip side is also true. If it's a rough tax year, a rough accounting, you're looking at your portfolio and you had a lot of losses, maybe it's time to, balance those out with selling a few winners. While you can carry some losses forward, it's always a good idea to try to reach some balance.
Mm-hmm. And so could you explain some of the advantages of participating in an intrafamily loan, referring to the grandma story, which we also have a video about that. You all should watch it. And how it enables individuals to reduce interest rates while maintaining associated tax breaks.
A lot of folks will tell you that you shouldn't borrow money from family, but this is actually one instance where you can actually have tax advantages as well as economic advantages from borrowing from family. Why? Interest rates have been cuts lately, as many of us know. Some folks now have high credit card bills. Student loan payments have kicked back in, and some of those are at higher rates than maybe seems affordable for students who just graduate. And you might have people who are looking to buy a home or to refinance a home, and interest rates are just made a little too high for them to do that right now. But if you have a relative who has some liquid assets, maybe they have a little nest egg sitting over in a bank somewhere, then they're willing to give you a loan. There's a special kind of intrafamily loan where the IRS says, as long as you hit certain minimums with the interest rates, then we're going to consider this a bona fide loan. So you have to hit what's called the AFR. It's a very specific number that the IRS puts out, Treasury puts out every single month. But as long as you hit those numbers, the IRS says, okay, we're going to consider this a real loan. Now, sometimes the spread between what that number is and what you're paying can be significant. If you're paying 30% on a credit card and the AFR is 5%, big difference. Same thing with the mortgage. If you're looking at a mortgage rate of 8 or 9 and you can pay 5% on the AFR, it's a terrific opportunity for you. And it feels, because it tends to be more informal, right? If you're borrowing from your parents, let's say, it feels like it wouldn't be like a bona fide loan for purposes of IRS, but it is. And the advantage to that on the part of the borrower is that you can still keep the same tax treatment that the loan would have had from a bank, even if it's from mom and dad. So a good example, again, with a home, if I borrow from my parents a proper mortgage, like we might write a promissory note, they might even record it in the county where I live. If I do that, I can still claim a mortgage interest deduction for the interest that I'm paying to mom and dad, even though I might be getting a more favorable rate from that bank than I would, say, my local bank. And it's a really nice way to preserve those tax advantages while paying less money. On the flip side, the person who's loaned you the money does have to bring that money into income as interest, but it's probably more or less the same amount that they would have been earning had they kept that money in like a CD. So there's really no difference to them. This works really well, actually, for middle class taxpayers. It works even better for high income payers because there's a lot of associated estate tax advantages that can also come into play that really aren't part of the year-end discussion. But it is a way, if you have a lot of money or if parents have a lot of money, it might be a discussion you want to have with your advisors. But if you're just looking to have it help paying off some student loans and you need, just a lash borrowed at a better rate than you would get at a bank, family is actually a really good place to start. It is worth noting that you want to make sure that you have a really good relationship with your family before you either make that ask or say yes, because you do want to still treat it like it's a business deal. And if there's a situation where you're not really communicating with your parents, or maybe you don't trust your uncle, probably not the best thing to borrow or lend money.
Kelly, I don't know why, but I feel like you're letting me in on like top secrets or something. Like, ooh,
I know,
everybody
right?
does not know this.
I love that tip, because I think that's one that people don't talk about. We always think additional lending, but there are, especially now, there are people who, retired folks, for example, that have money that they might be able to lend to their favorite grandchild.
Wow. So let's talk about electric vehicles. How do investments in electric vehicles and green home initiatives offer tax benefits at both the state and federal levels? And what considerations should be made regarding the new upfront payment scheme for electric vehicles?
So EVs are really interesting because, or electric vehicles, EVs, are really interesting because there's a lot of tax incentives to get folks to buy them. And actually, in some cases, there are more opportunities to buy them than actual cars to buy. But one of the things that the feds have done, in particular, and states are now following suit, is that they're offering you a tax credit to buy green. So you can earn up to $7,500 through credit, which is a whole lot, because just to make a question, a deduction is a deduction in your income. So it's like a dollar for dollar deduction in income. Credits are a dollar for dollar offset on the tax due. So that's a much bigger savings, right? Because that is, you kind of figure it out according to your tax bracket. So it can be a pretty significant savings. So you can get this credit of up to $7,500 for buying a new EV. There are a lot of rules, far too many rules to talk about in this short span of time. But a couple that you should be aware of is that the one that you should be most aware of is that they keep changing the rules. There are actually requirements depending on when you buy the car. That there must be a certain amount of the car produced in North America. There are certain kinds of efficiencies that you have to prove. So you want to do your homework. And you also need to be aware of when you can claim you can only claim the credit when the car is delivered. So if you go down to your lot today, car lot today, and you can, pick up the EV of your choice and they have it on the lot, then you could probably make that a year-end tax move. However, if they tell you it's backordered and you're not going to be able to get it to 2025, then you're not going to be able to claim the credit until 2025. So you want to, when you're out there poking around, make sure you check the time. So there's an additional incentive as of January 1st of next year, which allows you to get the credit on site at the dealer. So basically it acts like an advance or like a discount against a car payment. And again, if you start looking at those numbers, $7,500 is a pretty hefty credit or discount to be able to take at the dealer. So if you want the credit now, it's a year-end move. If you want to wait and try to get it up front at the dealer, go on January 1st. With respect to homes, there's a lot of different kinds of credits, and many of them have been around for a while. It's exactly the kinds of things that you would think. Things like buying an efficient central air conditioner, investing in solar, all of those kinds of things that we're sort of touting as good for the environment. They may also be good for your wallet, because you can, depending on, again, most of them have to be installed by the end of the year for you to get the credit. But, if you're looking at a new heat pump, maybe that's your Christmas gift, because you can offset that with a credit up to 30% to the cost of that piece of equipment, which can be pretty significant. Now, depending on which kind of credit you qualify for, so it depends on the thing, like which thing you're getting. Is it roofing tiles versus something else? There could be a limit, an annual limit, but in either case, there's no maximum credit. So most of the time you could keep, there's no maximum lifetime credit. So you can do this every year, right? So you can start looking now and maybe invest in the air conditioner this year and the heat pump next year.
Mm-hmm. Well, Kelly, what steps, should individuals take to assess their current financial situation before the year end, and how might this evaluation guide decisions such as catching up on estimated payments or making changes in the upcoming year?
Right. So this is the point where I tell you that you should have been doing this all along. But it's also the point where I tell taxpayers that I know that they haven't, and that's okay. There's no shame in it. Like, again, ideally, you'd already have a good picture of your finances by now and have taken all the right steps. But literally, if you're looking at your year-end statement, you're like, what happened this year? It's been a blur. I don't know. Maybe take a few hours out of your day. Ideally, again, you'd meet with your tax professional. But if this is something you'd want to do on your own, there are tools available to help you do that. Look at, is my picture the same as it was last year? If it is, did I withhold the same amount this year as I did last year? And that should give you a pretty good indication of what your tax bill is going to be in April. If you got a big bump in salary but didn't make any changes, maybe consider putting a little more money in via either an estimated payment, or you can actually just ask your employer at the end of the year to increase your withholding just a little bit. There are a lot of ways where you can measure, again, usually against last year's tax returns. Just look at your last year and check the check that you've received. Usually it'll tell you how much you've had taken out year to date. But since it's the end of the year, it's going to be pretty close to what happened last year, right? Hopefully. So you can look at those numbers, see if they match, see if there's anything else you need to do. If you find that you're going to owe a little more tax, you can either, as I mentioned, make an extra payment now, or you can do some of the things we've talked about, like make a charitable contribution, consider deferring extra income through through a retirement contribution. There's lots of ways that you can reduce your taxable income. Again, ideally, you'd be doing it all during the year. But if you are sort of feeling the scramble at the end, there's lots of resources to help you. One of them I think I want to mention for sure is that there is a withholding calculator on the IRS website. It's irs.gov. And it sort of walks you through and asks you some questions. You can figure out if you've been making the right withholdings. I think most people are pretty confused by their Form W-4, what you would fill out when you start your job. So this is a way for you to, check against what the IRS thinks you're going to owe, so that you are kind of keeping in line. Another way, I know Bill Baldwin's a fan of, you can use tax software, just run a demo, see what you think is going to happen. You don't have to have perfect numbers, right? You can say, I think I made this amount this year, just run the numbers and see what it looks like. And if it's in keeping with what happened last year, again, you're probably okay. If it's significantly different, you'll want to make a change.
So, are there any specific deadlines or extensions for retirement and related accounts that individuals should be aware of as they approach tax day, allowing for last-minute contributions?
Right. So earlier I discussed retirement contributions for retirement accounts like a 401k. Those are definitely year end. But again, if you are making a contribution to something like an IRA, you have until tax day, which is April 15th, so a little more wiggle room. But if you are looking to make that retirement contribution this year, you want to make sure that it's in by December 31st.
Okay, and considering all the strategies you've mentioned, what key factors should individuals consider when deciding whether to catch up on estimated payments or implement changes in their financial plan for the new year?
Again, I think when you start thinking about next year, you want to do exactly the same thing that I just said to do for the year end, right? Look at what you have, what you're expecting to come in, and what happened last year, and see if you think those things are going to be the same. If you know that there's something that's going to be significantly different in your life, you're going to want to plan accordingly. And while we always don't know what's going to happen, there's some things you can be pretty sure about, right? Like if you're getting married next year, hopefully you know that. Hopefully you know that now. Having a baby, buying a house, moving, all of these things that can have an impact on your taxes, you probably know now if you're going to be doing that next year, or that you're thinking, seriously about doing those things, and you can make some changes. Same thing with jobs. If you are getting a raise, if you are changing jobs, especially if you're shifting into maybe more than one job, you're thinking about picking up a side hustle. Those are things that would impact your next year's planning, and you want to start thinking about it now so that next year we don't have the same conversation about how to scramble at the end. Not that I'm downplaying scrambling at the end. It can be advantageous, and I'm a procrastinator too, I get it. But the more that you can plan ahead, the more likely it is that you can save.
Kelly, this has been so helpful. Thank you so much for joining me today.
Thank you.
Absolutely.